which is a new, what is it, multi-month, more than a year low, right?
Yeah, more than a year low.
It finally broke below the range. In case you didn't wondering, yes, Steve Van Metre is with me here at Eurodollar University Live, but right in time for our live program to begin, we've got Treasury yields that are dropping precipitously. The 10-year Treasury is down to what, Steve?
10 years. Sorry, I was looking. Yes, it's 4.05.
405. So we're talking like a 25 basis point move in just a couple of weeks. So lots of people buying duration, lots of people buying the short end of the curve. What do we call that, Steve? Bull steepening.
Absolutely. And we got 30 years 4.7.
4.7. So much for the rejecting the Treasury market out at the long end. So Treasury market's making a big move. Of course, the stock market's been making some moves, a lot of volatility there, though today the market came back a little bit, right?
Yeah, it bounced just a touch, but pulled back as we're heading into the close here, which is not really a surprise because, Jeff, you look at this market and the bond market is telling you there's really not a bullish case here. And I think that's the big story is we're in a bull steeper in the bond market, not a bear steeper, which is what a lot of people want this to be.
Yeah, they think the long end goes up. I mean, how many different excuses have you heard just in the last couple of weeks? It was the Chinese that are going to sell their treasuries because the regulators told the banks to sell treasuries. The Fed's independence, right? That was an excuse to sell treasuries. And there's a bunch of more excuses. The payroll report.
Right.
January payroll is really strong, apparently, and the bond market is saying not buying it at all. In fact, buying the exact opposite.
Well, you China, right? Telling the banks, dump your treasury. I mean, everything should tell you that
dump the treasury.
Yields should be going higher here, but they're not.
Yeah, then we got the CPI report earlier today, which was, what did you say? You called it meh?
Yeah.
There's basically nothing in the CPI report that would bother the market or the Federal Reserve or anybody else. It was essentially said that, look, the benign case for inflation that we've been looking for a long time continues to play out. There is no tariff inflation. Anybody who continues to talk about tariff inflation is basically wishful thinking at this point. It's more superstition than rational analysis. And of course, like we said, the bond market is buying completely a different story. Let's talk about something else that came up a couple of days ago. I know a lot of people have been talking about David Einhorn's comments. Mr. Einhorn said, look, I think there's going to be a lot more rate cuts than people are expecting because I think the Federal Reserve is going to cut a lot. So what was his trade? He said he was leveraging up on SOFR futures.
Yes, that's ridiculous. I mean, not the trade's not ridiculous, but his
reason
is I 100% agree with his trade, Jeff. I think he's right, but his whole logic behind it, I was like, what?
Yeah, what he said, in case you didn't, I think it was on CNBC, he said, look, I want to go long SOFR futures, and I think leverage SOFR futures, because I think there are going to be a lot more rate cuts from the Fed than people are anticipating. Of course, Steve and I are going like, yeah, that's what we've been saying all along. But then he said the reason for it was because he thinks that Kevin Warsh, the new Fed chairman, is going to come in, or Fed chair they call him nowadays, is going to come in. And as Einhorn said, he didn't come in to not cut rates. But his argument was that he will be able to sell the, Casey, Jeff, and the inflationists, the tariff inflationists at the Fed on additional rate cuts because despite the economy being red hot and strong, productivity from AI will allow the Fed to go lower without sparking renewed inflation. So it's sort of like getting to the right place for the exact wrong reasons.
Yeah, he has the right thesis here. But we talk about productivity. I think this is something a lot of people don't understand. And Jeff, I don't know about you, but it is one of my favorite correlated statistics because when productivity goes up, yes, inflation does go down because a worker is being more productive. So you don't need to hire more people. So what he's saying here is inflation's going to come down, the Fed's going to cut rates because more people are going to be out of work, which is exactly what happens when productivity rises.
And the thing is, the people being out of work had a lot. I mean, we saw the payroll revisions from the past week, the QCW annual revisions from the benchmark revisions that came in, which showed basically there was zero employment growth in 2025. And now even if this story is correct, even if the AI thing does play out and starts to really erode white-collar jobs in particular, you've got no payroll growth for the last couple of years, and then you've got AI stealing jobs. That gets you to rate cuts, but not because of a strong economy, right?
No, absolutely not. And that, again, his call, his trade, I think he's spot on. His logic is wrong. But then you look at the bond market today, Jeff.
Yeah.
And I think this is where...
This is the point, yeah.
This is where it all ties together because you look at the bond markets telling you growth and inflation expectations. Now, as Jeff just said, growth, labor market, weakening. Inflation, well, the CPI did not have some surprise number. It was, pretty benign and likely to trend lower. So the bond market saying is, yes, this is validated.
Yes, and that's the thing. The bond market is buying duration and short run rates too. It's not just one part of the curve or the other. We've got the entire bull steepening taking place. And like I said, this is an aggressive move here. And we've been waiting for this to happen, both Steve and I. We've been watching the 2-year because it's our favorite spot on the yield curve.
Right.
I mean, you go back to videos that we did back in 2023. We're talking, hey, watch the 2-year, because the 2-year was telling you back in 2023 the Fed was not going to keep hiking rates and that it was not going to be higher for longer. So we've been watching the 2-year for this indication that the rates may be ready to finally make another move, or not finally, to resume their next move. Whether or not that leads to Fed rate cuts in the next couple of meetings doesn't really, I mean, we're 2-year spot in the curve. Doesn't really matter about the short run of the Fed. What the 2-year spot is saying is that conditions across the economy as well as the financial system. Let's not forget that the potential harm from the AI bubble going bust is also playing into this, because if that happens, that's going to be economically negative too. So the market is saying we've got all of these risk signals from all over the place, and now we're more and more comfortable. The Fed is not going to stay in the way here by holding rates, or even, some people were talking about how central banks are going to be hiking rates this year. Right? I mean, that was a couple of weeks ago. I was whatever said. Central bank. The market is saying we're comfortable with the fact that's not going to happen, and all these economic and financial risks are building up to the point that now we've got the 2-year down to a more than year low.
Yeah, definitely more than a year low. And the key thing here is you're getting validation from the long end of the curve. And normally you don't have to have that. But the fact that the long end is starting to drop is telling us that, look, the situation in the economy that we hear from the Fed or that we saw in the payroll numbers isn't going to be what everyone's hoping it's going to be. And that's the key thing here is we are in a bull steepener. This is not bullish for stocks at all, Jeff.
No, it's not bullish for anything. It never is. I mean, that's why I hate that term. They call it bull steepening, but it's only bullish if you're owning safety and liquidity. And that's never a good place to be for basically the rest of the world. But I think the thing to really focus in on here is when you look at the yield curve and the shape, and I talked about this in recent YouTube videos. I know, Steve, you talk about this all the time, whether on your YouTube channel or off the YouTube channel. We talk about curves all the time. The yield curve doesn't want to be flat. It certainly doesn't want to be inverted. It doesn't want to be flat either. And when you look back through past historical episodes, what you see is that the spread between the short end and the long end, let's say the 3-month bill and the 10-year Treasury, you're talking like 200 basis points, really closer to 300 basis points. And so the question is, if you start with the long end, if the long end is not going to go higher and the curve still wants to steepen out, that means that the short end of the yield curve has to drop so that it's 200 basis points steep to the long end. So let's assume that the long end rate doesn't move from here, that it's stuck right at, was it 406? You said 405.
Oh, well, yeah, 406. Yeah, 30 years at 47.
So if the 10 years at 405 and you're expecting 200 basis point steepening, the 10-year could not move the rest of this year, next year in the long run. That would put short-term rates at right around 2% and going lower. So the question was always about, the narrative beginning this part of the year was, if central banks were done with the rate cuts, like everybody was saying here, that the next move out of the Fed, the ECB, already the Australians, was going to be rate hikes, then you would expect the curve to steepen out from the long end, where the long end would go up and it would be 200 basis points to 300 basis points higher than where the front end was, which is at 350. So we were expecting the 10-year to be moving its way toward 550 or 6% if that was the case. Instead, from all the data that we've been getting and the market behavior we're talking about here, the long end wants to go down, which means the short end has to go down a hell of a lot more to get there. So we are talking about, front end rates around 2%.
Yeah, and so you think about what this means for financial conditions, because we're kind of programmed. We hear from the Fed that lower interest rates inject liquidity, create economic stimulus. But in reality, what we're seeing here is financial conditions are tightening. And the problem again, as Jeff just said, it's also part of the long end of the curve. So it's saying across the spectrum, not just in the short term window, but looking out over time, the bond market's saying, look, the economy isn't going to get better. And as we pull back, you could say, does that mean the labor market's going to get better? The answer is no. It's highly unlikely. So you're going to see across the board that things are going to get a lot worse here, and that's kind of what the bond market is telling us right now.
Well, Steve, it's already validation that like I said, there was zero payroll growth in 2025. We have an economy this size that had no jobs generated in an entire calendar year. How is that anything other than a recession? And the problem is people don't want to call it a recession.
Well, it's because the stock market, Jeff.
Right,
They're
exactly.
looking at the stock market, it went up, and that's the reason why.
Record high stocks
Right.
and the recession, you don't get those two things together.
Right. So underneath the financial system, monetary system saying, look, what you're seeing in equity prices is not validated.
No, you cannot have an economic boom when you have no job growth, zero job growth. And even the establishment survey under its revisions showed zero job growth for an entire year. And so the only way you can get around that, right, is to say, well, it's some kind of artificial factor, or artificial temporary factor, which brings us back to the reason why we're doing this live stream. What the market is saying by the 2-year going lower is no, it was not an artificial factor. It was not some temporary thing. The job market that we had last year, as Steve said, is looking like it's going to get worse in 2026. It's not a one-time thing. It continues to move forward. And the market, like I said, is getting more and more comfortable that there isn't the tariff inflation or any kind of inflation that would lead to the Fed interfering at the front end. That's why the 2 years dropping. So you have this consistent economic picture from the yield curve moving in this direction, and now making a new low on the 2-year at least. Well, watch the 10-year. The 10-year is the next one to go. As the yield curve continues to move lower and lower, that just offers more and more confirmation and validation.
Yeah, absolutely, Jeff. And then you look at retail sales recently, came in virtually at zero. And so you start to think, we see these companies last year said, hey, we're going to do one round of layoffs. Maybe if we have to, we'll do another. And then they did, and they said, that was it, we're done. And then the first of the year, here we see the layoffs. And that's exactly what the bond market is telling you right now, that this trend is not going to change.
No, it doesn't mean, let's be clear, it doesn't mean necessarily we're going to get 2009 style layoffs over the next couple of months. But what it does suggest, at the very least, again, the market is getting more and more confident. We're going to see more layoffs from big companies, here and there. That we have the no hire economy that gets more and more into the some firing. And then the real risk, is even the Fed knows, is that eventually you have some firing that continues to go on. Eventually, consumers stop spending entirely, and then you lead to the part of the economy that everybody recognizes as a recession. That's when you get the mass layoffs. But we don't need that. And the market is not saying we're forecasting that in the near term. What we're forecasting is, at the very best, more of the same last year. Like I said, an entire year without payroll growth was absolutely astounding. And that is not a booming economy. That's not a strong economy. That is not record high stocks. That is instead a bull steepening yield curve that is now bull steepening even more than it had been before.
Yeah, and so Jeff, we had this no hire, no fire, but now we're transitioning to a no demand economy where consumers are really saying, hey, look, inflation is too high, my hours are dropping, I'm really concerned about my job, my friends are losing their job, I have to cut back my spending. That's what we're seeing in the bond market here, saying, look, the consumer's tapped out.
The consumers, we've seen that in retail. Like I said, there was a pop up in retail sales during the summer, which you and I both talked about. That was tariff distortion, right. A lot of spending, or especially on automobiles, trying to get ahead of the idea of tariff inflation. The prices maybe were going to go up at some point because of everybody said they were going to, so consumers bought some stuff. But retail sales ended the year incredibly weak. Payroll growth was not there. We have zero confidence. The market has zero confidence in the January payroll number, because you should have zero confidence in the January payroll number, because the entire payroll report itself is basically going over every single reason why you should pay no attention to the preliminary estimates. And so that's, with the 2-year making new lows, the market is telling you we have zero confidence in all of these things. We have instead growing fears that all of these financial and economic risks are indeed going to continue and extend into 2026, which means we're not going to stay the same. We're not going to see the same level of no payroll growth. It's going to likely be some degree of job shedding overall, which we really can't afford at this point.
No, and so Jeff, you think about like these AI companies. So you might say, well, hey, lower interest rates, it's got to be great because they need to borrow just billions and billions of dollars. But now the problem is it's going to be harder for them to get a loan, and that's not just for those companies. It's going to be across the board. Consumers, businesses, people are going to go to the bank and say, hey, I need some money because things will slow down. They need a bridge. And the banks are going to say, hey, well, you know what? Sorry. And that's where you start seeing the problems. That's what the bond market's talking about.
Let's finish up with that thought, because I want to press that thought a lot more, because that's when we're talking about the economy, that's bad enough. I mean, people not having jobs and people losing their jobs, that is certainly bad enough. But there are financial implications to all this, which is what the stock market's really reacting to, the selling in cryptocurrencies. The risk aversion that's shown up there. It's the implications of an economy that isn't growing. And the implications are, like you said, the credit cycle. The credit cycle slammed shut. It hasn't gotten there yet. The credit cycle is shifting. It has noticeably shifted, but eventually it starts slamming shut, which leads to second and third order effects, which is, the credit cycle slams shut, and then the AI boom stops, it reverses. They can't borrow as much money as they need to. The data centers don't get built. They can't fulfill customer commitments, and it just leads to this cascading effect. So the bond market, in effect, is saying, look, we see where things are. We have zero confidence that they're changing for the better. And now we're looking ahead at the implications of having no faith in the economy and everything else shifting for the better. So the implications could become much broader than just what we're seeing in payrolls or retail sales.
Yeah, that's a key point, Jeff, because you're right. We could see some more layoffs as the economy normalizes, but if credit tightens up, and that's a big concern, now you're risking, again, as you said, second, third order, bubble starting to pop, businesses laying off not because they don't have demand, it's because they can't get credit. That's when things really start to go wrong.
And it's the if, right? If things start to go wrong, what the market is saying is the chances and the probabilities, because everything is about probabilities here. The probabilities and the chances of if that happens are going up, and that's why the bond yields are going down. And so we wanted to pop in here to talk to everybody about that, because I think that was a key one, is see the 2-year Treasury hit a new low here. We'll follow it and see if it continues to go there. And the next thing, right, the 10-year, to see if the 10-year can get below 4% and stay there.
Yeah, I think what we're seeing here is what we're trying to tell you is the bond market's flashing a warning. It's not saying tomorrow there's going to be a financial crisis. Just saying, look, if things continue down the certain path they're going, the outcome is not good.
The outcome is why you own treasuries in the first place. So welcome. Thanks everybody for joining us from Eurodollar University live here in Florida. See you again very soon.